Give me another lesson that the wealthy people do differently from everybody else.
So the thing about being wealthy that I'll also share is once you have money, James, you start to borrow and use leverage for anything else, right? So if I sell my stocks, I'm paying 20% if I kept them for over a year, but I don't want to pay 20%. So because I'm worth $100 million, UBS says, hey, Ann, you can have a $50 million line of credit with us. So I get to borrow money at like 5% right now, which is amazing. I don't have to pay any taxes.
This is really
on the
good.
money that I borrow.
So it's safe to say that wealthy people, they play a different game than everybody else.
Yeah.
Once you reach a certain amount of wealth, you start to borrow and leverage. And what she is alluding to here is avoiding triggering taxable events. Wealthy individuals are experts at avoiding taxable events because they understand the tax code. She mentioned, I do not want to pay 20% for holding it over a year. She didn't allude to what that was or how she determined the 20% or who's going to take that 20%. She's referring to the IRS. She's referring to the long-term capital gains tax rate, which states that if you sell an asset that you held for over a year, you are subject to long-term capital tax, which is equal to 20%. People would ideally like to be in that 20% scenario as opposed to a 37% scenario. But the wealthy individuals understand that what's better than 20% is 0%. What's better than paying a minimal amount of tax is paying no amount of tax. And she is saying that instead of selling my stocks, I'm going to borrow against the value of my stocks. She was referring to a bank. She was referring to UBS giving her a line of credit with a rate of 5%. And what she does here is leverage arbitrage, because the moment she is able to use that loan at 5% to acquire assets that earn her income at a rate higher than 5%, she's now in a net favorable position to pay off that loan. And she has excess cash flow surplus because she has not incurred tax of 20% from selling her assets. So not only does she gain liquidity, she gains the non-taxable events and more cash to acquire even more assets to grow her wealth even further. Now, this is easy to say, but it isn't simple. You are putting yourself at risk here because you are leveraging. You are putting yourself in a debt position. And what happens if you buy an asset that isn't generating enough income to match that interest rate on the loan? So these are the risks that you have to take. But as we always say, as we've always learned in whether it's economics or the risk of business, your risk tolerance is directly proportionate to how much income you make. These wealthy individuals are able to place bets on themselves to not only not have a taxable event, but to know that they are going to use that excess income, that additional income, to buy more income producing assets as opposed to spending it and wasting it on liabilities. The VAR verdict is that I'm going to agree with the on-field decision. My name is Ronnie Foguin. I'm a Canadian and US CPA who specializes in generating 4 to 5 figures tax savings for content creators legally, annually. Tap in with me. See you guys in the next video.